And we are recording. All right, good people. So here we are carrying on with our discussion. I think we are already in I think it's the third week, fourth week of classes. Time flies. And we are continuing with chapters 4 and 5, our discussion on chapters 4 and 5. Notice that as per the course outline, tonight's class was intended to be earmarked for the group assignment. And the group assignment has been available for a while, and I've already received submissions from two groups. For groups that have not yet submitted their assignment, there is no compulsion to attend class. I am recording class. I will be posting the recording to D2L. So for those groups, please take this time to complete your assignment and get that out of the way. For the remainder of the participants, I would just like to remind you that on Monday last week, after completing our first quiz, okay, the status of the quiz, it's taking a little bit longer for me to mark the written part. So I expect that will be done hopefully by Wednesday. So it's not completed by tonight. That's why the marks have not yet been released. You might have gotten feedback on the multiple choice questions, but the written part has not yet been marked. All right, so please bear with me. It takes a little bit longer to mark the written portion. Um, I hope to have it done by Wednesday evening, and you should see the marks posted on D2L. Now, last week we started talking about the um, efficient market hypothesis, and we had taken a sort of a calculation breather at this point. We were talking about how the capital asset pricing model can be used to parse out the actual return on a stock, the actual profit or loss on a stock on any given day or any given period of time. It can be split into two parts: the expected portion and then the abnormal or the um, beyond the expected return. And so that is done by taking into account the um, capital asset pricing model, which is the return on any given security is a function of the risk-free rate, the stock's beta, and the expected return on the market. And towards the end, I was asked, okay, we don't know what these terms mean. So we had spent a few minutes going through the Yahoo Finance website. I see a hand has gone up. Daljit, yes, please go ahead.
Hey, doctor. Actually, I couldn't attend the last class after the quiz. I don't see the video posted from last week's class. Did you post it or not? I'm just curious.
Oh no, this is maybe I forgot. Give me a quick second. Let me check that. And maybe somebody needs some clarity on a particular matter, maybe something we did that didn't quite stick. Doing all right so far then. Okay, so by way of a reminder, this is the capital asset pricing model that is used in the world of finance. And what we do with this model is we figure out an expectation. We calculate an expectation about how much the return should be on any given stock. Now, today was a down day for the stock market, right? So um, over here we expect that uh, in any given company's case, if a company announces earnings, if we do a quick little search on Google, for example, if we do a Google search on uh, earnings announcements. So, is there any recent earnings announcement? Um, recently, we had an earnings announcement made by Alphabet, the parent company of Google. So we go and look at what the earnings number were. CNBC would probably be a good place to look at. So this is usually companies will report earnings, and then there's coverage in the business media. So over here, there's something wrong with my video, so I'm going to stop the video. A bit distracting. So over here, Alphabet, the parent company of Google, it said reported its earnings. This is from the 2nd of February. Reported earnings. The company stock dropped nearly 4% after hours. And here's how the numbers were. So EPS, earnings per share for Google's parent company, was $1.05 as opposed to $1.18. Now, $1.18 was what the market had anticipated, right? And when we say the market, it is usually stock analysts. So companies are followed by stock market analysts. And the consensus was that Alphabet should have earnings per share of $1.18. Their actual earnings per share was less than that. So compared to the expectations, Alphabet's stock performance was lower. Its revenue was a little bit lower than what was expected, but not by much. YouTube's advertising revenue was considerably less than what was being expected. The cloud revenue was also a little bit lower. And however, on the cost side, their traffic acquisition costs were lower than what was expected. So overall, there were some misses that the company did, had compared to what the market's expectations were. And then if you read the report further, it says the company said it'll take a charge of between 1.9 billion and 2.3 billion related to layoffs of 12,000 employees. So that's going to be a loss, basically, an additional compensation expense. And it also expects to incur costs of about $500 million related to reduce office space. And then it's just more details about what happened relating to Alphabet's revenues, earnings, etc. Okay, and it's also experimenting. There was report that they are facing competition from Chat GPT. So these guys were planning on launching their own artificial intelligence. I think they have already announced it, called the Bard, right? The Google Alphabet is going to have its own version of artificial intelligence. Now, what happened over here is that in response, and so this earnings was reported on Thursday after the markets closed, after the bell on Thursday. So if we now open up Yahoo Finance and search for Google, That's gold. We are looking for Google. Oh, okay. I see why. Because it's Canada. We don't want Canada. We want the regular finance Yahoo. And so Google, Google. Okay, Alphabet. That's the stock. Now we are looking for Friday. So today is Monday. We are looking for Friday's performance. If I just scroll here. So on Friday, the stock had opened at 107.80 and it closed. So we look for historical data, it's better. If I click on historical data, then Friday, the 3rd, Google stock opened at 102.93. Its previous close was 107.74. Okay, so we need to look at what happened for Friday. Thursday, February the 2nd, is when Google reported its earnings after the markets had closed. So the markets had closed at 107.74. And on Friday, the stock price closed at 104.78. So if we were to use this data now to see if there is any abnormal return on Google stock, right? If we were to try to get that sense, all right? Over here, Google earnings. They were reported on February 2nd after the market closed. So Feb 2nd closing price, we got Feb 2nd, the closing price was 107.74. On the next day, Feb 3rd closing price was lower at 104.78. So we're looking at a drop, right? We're looking at a drop. So what was the percentage change? $104.78 divided by 107.74 minus 1. You're looking at a percentage change of negative 2.75. This is the actual return. For Friday, right after the earnings numbers were declared, on a single day, the actual return on Google stock was a negative 2.75. Now, to see if this piece has any, if this actual return of negative 2.75% has any element of an abnormal return, we need to be able to calculate an expected return for Google for that one day, and then subtract the expected return from the actual return. To get to that, right? So this negative 2.75 is the return on Google stock, RJT, right? Now, we need information to get the expected return. We need the following. We need the beta of Google stock. We need the market return for that one day. We need the risk-free rate of return. And then we can calculate the expected return. So beta on Google. So for Google, if you go and look at Google's summary, Yahoo Finance says that the 5-year monthly beta for Google is 1.09. The Google stock is pretty much in line with the market, just a slightly slightly higher beta than the market. 1.09 is really not a lot higher than what the market is. 1.09. Now, what was the market return? The market return here, if we have to look up now, which market does Google trade on? Trades on NASDAQ. Okay? So if we look at NASDAQ composite, right? If we go with NASDAQ composite, that's the NASDAQ composite index. Historical data on the 2nd of February, the NASDAQ composite index had closed at 12,200.82. Over here, this is the result for Google. And if we look at NASDAQ, which is the market, February 2nd, the market had closed at 12,000. 12,200.82. And the very next day, if you look at what happened on February 3rd, NASDAQ closed at 12,006.95. So it was a down day for the NASDAQ index as well. If we calculate what the return was, it was negative 1.59. So market return was a negative 1.59%. What about the risk-free rate? Now, in order to calculate risk-free, we have to look at where Google operates primarily in the US. So you want to look at US Treasury bill rates. Now, the US Treasury bill rate is currently 4.902%. 1 year usually Treasury bill rate is 4.902%. The Treasury bill rate is 4.902% per annum, which means for a single day, a year has 365. So 0.04902 divided by 365, for a single day, that rate is very, very, very small, really, literally next to nothing, right? So the risk-free rate would not have had a huge impact. Now, if I bring the market model into play, the expected return on Google stock is the risk-free rate, which is 0.0001 times 1 minus the beta, which is 1.09, plus beta 1.09 times the market return, which is a negative 0.0159. So if I run this calculation through, risk-free rate times 1 minus the beta plus beta times the market return, I get an expected return on Google stock of negative 1.73, right? This is what we expect. Since the market was doing negative, we expect Google stock for that day should also have had a negative return, but not as much as it actually did. So there was a slightly I would say, amplified response to Google's earnings announcement. So abnormal return is actual return minus expected. Actual return is negative 2.75%. I subtract from that the expected return of negative 1.73%. I get abnormal return equals just slightly over 1%. Okay, so there was an abnormal portion. Now, the abnormal returns have historically been growing smaller, and that is because a lot of the trading is now done by algorithms, by computers, artificial intelligence. And so, back in the day when more humans were involved, the abnormal returns on stocks after earnings announcements used to be, higher numbers, larger numbers. Now that proportion has gone down. But as you can see over here, we can apply this model on anything. So something to kind of think about, uh, just a thought about, let's say, if any of you would like to put this into action, if you just want to see if you have a favorite company or set of companies, and you want to track the stock and see how it's responding, right? To either market-wide information or information that is specific to the company, this might be a useful tool to actually be able to apply, right? So any questions on what I just did, what I just went through? Doing okay? All right then. Do I have you folks around, or like am I just talking to the air? Like, if yeah, Talita, you're there?
I'm here. I'm listening.
Okay.
Thank
Yeah,
you.
because sometimes you don't know, right? I mean, yeah, I'm just stopping to ask how people are doing, and nobody's around because they're
Um,
working on the assignment, and so I shouldn't pause in that case. I should just keep going. All right, then. I will carry on from this point onwards. So we've looked at how to decompose actual stock returns into expected and abnormal portions. Um, this is a fairly commonly asked question. Maybe for the next quiz, you might expect something along these lines. Capital asset pricing model, how does that matter to us accountants? Um, we do make very important assumptions when using capital asset pricing model. One being that a company's beta doesn't change. And secondly, we assume that there is no inside information in play. Now, these two assumptions are problematic because when we assume that a company's beta, its covariance with the market, does not change, we are giving rise to the possibility of estimation risk. The reason being, if you think about Apple, for example, 30 years ago, Apple was a very small company, relatively. And the track record of Steve Jobs and his colleagues was not that strong at that point in time. And to a point that, from what I recall, Apple also flirted with bankruptcy, etc. So At that point in time, Apple company's beta, stock beta, would have been fairly high. If we go and look at Apple company's beta now, I would think it is probably going to be close to one, just as Google. 15 years ago, Google would have been still a fairly speculative affair, and its stock beta would have been fairly high. Now, the beta for Google or Alphabet, the parent company, is pretty much in line with the market. So, for no company do you ever see a beta that is not changing. We assume that a company's beta does not change, then we are introducing the possibility that we will estimate the risk associated with the particular stock incorrectly. And when estimation risk goes up, the result is that people compensate, people who are looking to make an investment, they compensate for it by increasing their required rate of return, right? When investors increase their required rate of return, the effect is that for the company, its cost of equity capital goes up. And this is a concept borrowed from finance. A company's stock price can be modeled as the present value of future dividends. And so if you use a higher discount rate, the company's stock price will go down as a consequence. When the cost of equity capital goes up, the company's stock price goes down. So that is something to watch out for us accountants. We need to make sure that um, it's something that people are aware of, that we should not be assuming that beta stays stationary. As a company's situation changes, as a company's relative size changes to the rest of the market, there is an impact on beta. The other assumption that we make that there is no inside information, we're kind of wishing away that um, people will not act in their self-interest, and not in contrary to the interests of the others. So information asymmetry is something that cannot really be avoided. You have the adverse selection problem as well as a moral hazard problem that exists due to the existence of information asymmetry. And insider information can be seen in both, right? Adverse selection as well more as a moral hazard. So before a company goes public, the insiders, right, the top management or the owners of the company, they know a lot more about the company, how well it's been doing, the risks that it's facing, than the outside possible new investors ever will. And even after the company's gone public, the management of the company knows more about what's happening, what's going on in the company than the shareholders do. And it is possible for the company's management from time to time to hide poor performance, right? They will just not reveal the true nature of the poor performance of the company or the excessive risk that is carrying. Those risks are, well, finally borne by the shareholders. But because the company is managed on a daily basis by the managers, often that information is not passed on. And there you have the moral hazard problem. So, considering the impact of estimation risk, as accountants, we need to take cognizance of that estimation risk is something that we need to work on to overcome. And so if we can somehow reduce the estimation risk by instituting a more informative reporting system, so if the company's financial reporting could be made more informative, more user friendly, more transparent, the stock beta can be reduced, and that will have an impact in the form of lower cost of capital. This was established by a paper authored by Lambert, Lowe's, and Verrecchia. However, estimation risk is non-diversifiable. So that is something we have to keep in mind that that a person can reduce their their investment risks through stock diversification. So rather than putting all your money in a single investment, if you spread that money across different investments, you're able to get what is called the protection of diversification. Your risk is reduced. Estimation risk cannot be diversified. So that can only be reduced if we have a more informative reporting system. So it directly ties back to us accountants. It's our job as accountants to make the information system more user friendly, more transparent. The flip side of the argument that Lambert, Lowe's, and Verrecchia made is pointed out by the paper written by Ashbos, Cave, Collins, Kinney, and Lafond 2 years later, that companies that have known deficiencies in internal control, and internal control deficiencies is something that auditors will highlight. Companies that have deficient internal control mechanisms, they tend to be perceived to have higher estimation risk, which leads to higher beta, and a higher beta leads to a higher cost of capital. So, from an accounting point of view, there is one, the information system, and secondly, you also need internal controls to be robust. If a company does not have strong internal controls, then in spite of all the efforts that accountants make to have the reporting system being more informative, the company will continue to be perceived as higher risk and its cost of capital will be higher, which results in lower stock price for shareholders. Right? So estimation risk being tied to the notion of information asymmetry makes us want to revisit the whole notion of information. Remember that information asymmetry, it's got two presentations, adverse selection and moral hazard. Information asymmetry is very, very, very important to understand. If we have pervasive adverse selection is where one party has access to more information or better quality information or more timely information than the other. It can result in the counterparties to the transaction from just shying away, from withdrawing. So I don't know how many of you are following the news, the financial news, but there has been in very recent times over the last week or so, there's been a very high profile case involving a very large conglomerate, India-based conglomerate by the name of Adani. So there is Mr. Gautam Adani, the chief of Adani Enterprises. He was briefly one of the very, very, very wealthiest individuals in the world. Now his group, has its fingers in multiple pies in India. A short seller group by the name of Hindenburg Research issued a report that they had some doubts about the reporting quality of Adani Group India. And the Adani Group was at that point just about to come up with an initial public offering. They were selling shares of the major holding company of Adani, and that was going to be billions of dollars of an initial public offering. This research report was issued, and since then, what has happened is over $110 billion worth of market capitalization has been lost. So people, shareholders started selling. The prices, stock prices fell 50, 60% or more in certain cases. And the initial public offering that they were going to launch, it ended up having to be canceled. So this is a very stark example that when people think that they don't have access to high quality information or that the other parties may be hiding something, uh, people will just not want to do a deal. And if a deal can't happen, from a company's point of view, from Adani Enterprises' point of view, they lost out on an opportunity to raise several billions dollars in the equity market for the company. Okay, so adverse selection can have very profound impact. It can result in market failure. Now, the term market failure here implies that companies will not be able to complete financial dealings. So that could be either in the inability to issue shares, or think about it, inability to raise debt capital by way of issuing bonds, or even not being able to find banks willing to lend money, right? So market failure simply implies that capital markets will not work in the way they are intended to, because people will just not want to invest or lend money. When you have moral hazard is where management um, taking actions in their own self-interest as opposed to the overall interests of the shareholders, that too results in markets falling short of what they would otherwise achieve. Now, the result of this, when you have information asymmetry, the result is that often people will just think that uh, the whole market is full of is made up um, of bad actors, right? So that results in pooling. And pooling is what contributes to the lemons problem. Now, this was a very famous paper written by an author called George Akerlof. It was an economist written in the early 1970s. And it can be better understood by, I think there is a video that I can find for you folks. If you can just give me a quick second. I'm going to pause this recording here. If you watch that short video, gives you a good idea about what I'm talking about. So resuming our recording here, I have an example from the textbook using the concept of information asymmetry. We're looking to answer these questions. A, we observe that used cars sold by new car dealers sell for a higher price for models of the same make, year, and condition than used cars sold by used car dealers. Why? So we just looked at the video which talked about the market for used cars, and you saw the person in the video describing, oh, how there are the higher priced cars just because the buyers are not sure whether they are being offered a higher value car or not. They are only willing to offer less, more or less than average of the values of the high quality and the low quality cars, that essentially derives out the higher quality. Now, if we refine that notion a bit and introduce that these are used cars now being sold by new car dealers, so think about Country Hills Toyota, and then used car dealer, say not a very well established, but a dealership that only sells used cars, and you have similar make, similar year, condition, and you will typically find, well, right now is an anomaly. Right now, the over the last year or so, the market for used cars has been really hot, but under normal times you'll find that there is typically a big gap. What do you think is the reason there? Why might that be the case? That if I have the same, let's say, 2017 um, Toyota Highlander, Country Hills Toyota will probably be able to sell it for, I don't know, $30,000, whereas another, or someone selling it on Kijiji might only be able to sell it for, say, 25,000. A fairly substantial difference. Why do you think that might be? All right, an awkward silence. Anybody? Nope. Okay, I can give it a shot. I don't know if I will be able to communicate my idea clearly here. But if you think about what makes a new car dealer different from a used car dealer, a new car dealer wants to form a relationship with a customer for the longer duration, right? Right now, the buyer might only be looking for a used car, but over time, maybe they might, be in a position to upgrade to a new car, and the new car dealer wants to make sure that the buyer will come back. So they've got something riding there. They've got their reputation, right? They've got their reputation riding. So we saw in George Akerlof's Lemons problem that with the used cars, um, just because buyers are not sure when you have the existence of information asymmetry due to the adverse selection issue, right? So in the first case, right, there is information asymmetries present in the form of adverse selection. Right? This relates to the adverse selection problem. A new car dealership has considerable reputation at risk. And so it is likely to only offer high quality used vehicles while sending the rest to auction. This is at least what I have seen. All right. So if they will take in trades and anything older than a certain length of time, they will send it directly to the auction. Something, so anything less than say 7 years old, they will keep, they will test, they will run 100-point test, 150-point inspection, etc. This is usual, right? So they will do that to make sure that there aren't any huge issues. And only when they're satisfied that there is nothing that is immediately going to result in the customer, the customer that drives away with the car, that they're not going to see an immediate shock in terms of repairs being needed. Well, those would be the vehicles that they would sell. The other used car dealerships may not be as discerning, so they might actually, be willing to, sort of offer a lower price point, uh, but at the same point in time saying, hey, you drive away, we are not going to, there is no warranty. Now, of course, that is also not right. Over time, we have seen, I've at least seen that the likes of Automax and those other companies that have started to mushroom into multiple location companies, they have started, these warranties, like you get 3 month or something like that, that you take the car from us, something happens within the first 3 months, we will take care of it. So those warranties are essentially a means of providing assurance to the buyers that, hey, if something goes wrong immediately, we have your back. Beyond the 3 month period, if something happens, that's on you, right? So this is sort of the way that you try to convince the buyer that they're not going to be saddled with a lemon, right? The absence of trust that arises due to adverse selection, they seek to overcome it. So new car dealerships, just because of their reputational effects, they will typically not even bother trying to sell a car that they know might have some defects. So as a buyer, you probably walk in and are willing to pay a premium. You're willing to pay a higher price because you expect that that part of, like, the expertise has been applied, that the dealership has put in the time and effort and money to inspect the cars, and they will not knowingly sell you something that is of lower quality. That makes sense? Okay, moving on to a second one, part B. Why would a fire insurance policy contain a $1,500 deductible provision? So this one here, deductibles, be it health insurance, fire insurance, automobile insurance, etc., are a means of protecting against the moral hazard. If the insured has to pay a deductible, a sizable deductible here, right? I mean, $1,500 is a uh, is a pretty sizable amount. They are expected to take precautions, right? They are expected to take precautions to avoid losses by fire. Now, again, I mean, if it does happen, the company will pay, but you don't want a situation where someone is willfully, right, causing damage to their property. And if you think about it in terms of health insurance, or there are co-pays in play. Um, the reasoning there again is that you don't want people to sort of abuse the system, make too much use of the system, buy uh, medicines unnecessarily, because if they are going to have to pay a portion of the cost, then they will likely think twice. Right? They will not be profligate in the use. So insurance works on that principle that yes, after the fact, we don't know what is going to happen, but we want the insured party to take precautions. Okay, part C. Why would a life insurance policy require a medical examination before approving applications for new policies? So this one, medical exams serve as a means of protecting against adverse selection. The exams highlight pre-existing health issues, which the insurance company takes into consideration when deciding whether it would extend coverage to the party, and the rate of premium to charge. If somebody is very healthy, uh, the insurance company would be very, I would say, very happy to offer them the insurance policy and would likely charge them very competitive rates. Now, if someone has a pre-existing illness that is fairly well managed, let's say they are diabetic, but their diabetes is under control, the insurance company may still give them coverage, but will charge a higher rate of premium. Now, if somebody is diabetic and their diabetes is poorly maintained or poorly controlled, or let's say if someone has a terminal illness and they are looking to get health insurance, they are looking to get life insurance, they'll likely be turned down because the risk is too high, right? So insurance companies require such medical exams to um, to protect themselves against adversity. Now, there are companies that offer no, insurance without any medical examinations based just on answers that people provide to certain questionnaire. There too, they're trying to screen. They're trying to screen, um, and people that have pre-existing illnesses, considerations, they may be accepted, but they are accepted at very high premium rates. Right? So, uh, insurance works on the logic of pooling. So you need a large number of people to be in there. So yes, even if someone with a pre-existing illness is at a greater risk of developing health complications or dying early, if you have significantly large number of people, they are not going to all pass away at the same time. At least that's usually how the actuaries will think. And so therefore the companies like there are Canada Life and so on. They're able to extend insurance even to such applicants. All right, the last situation is a company plans to raise additional capital by means of a new issue of common shares. Before doing so, it hires a well-known investment house to help design and market the issue, and also switches auditors from a small local firm to a big four firm. Why? Again, this is an attempt to manage the adverse selection problem. The well-known investment house and switching to a big four auditor are both attempts to enhance the credibility of the issuer. Now, we have to understand that there's reputation at risk. Both the investment house and the auditor have their reputation at risk, right? So for the market participants, this enhances or increases their confidence in the issuing company, resulting in both a willingness to invest and possibly also a lower cost of capital for the company. Right? So these are all examples of how information asymmetry could be in play and how parties would try to manage the negative impact of information asymmetry on the circumstance. You know, if there was pervasive um, lack of confidence in the market, the company that's planning to raise additional capital will find it very difficult to be able to do so if they did not have the backing of a large investment house, or their financials were being audited by a small local firm, because these appearances matter. in capital markets, appearances matter. And that's kind of the same theme as you saw here for the used cars. So if the used car is being sold by a new car dealership, the reputation effects add to the credibility of the cars. People would be willing to pay a premium just because there's the credibility of the new car dealership on the line. Okay. There's no immediate questions. Moving on. Just looked at information asymmetry. Keep in mind, information asymmetry exists in well-functioning markets as well. That's due to insider information existing, and that creates adverse selection. And then even for companies that have their issues subscribed to, if management stops working hard to protect the interests of shareholders, i.e., they start shirking their duties, that leads to the moral hazard problem. And in both cases, investors will be less trusting of management, and they will not want to either not want to invest at all or invest less for the securities, less for the shares or bonds. And that results in either market failure or incomplete markets. Now, there is a notion of fundamental value of a security. Now, the fundamental value, if you can see um, the diagram there, it's the value that that particular share would have if there was no reduction or reduction of trust due to the existence of insider information. Right, so that's right at this edge, the edge of the bigger circle. That's where the fundamental value is. The edge of the inner circle, the one that's shaded, that represents the efficient market price. Now, it could be argued that the role of financial reporting is to try to minimize the negative impact of inside information and stretch the efficient market price of the company to get as close as possible to the fundamental value. Okay, so that is done, that is achieved by providing improved in disclosures, improved information. You want to reduce the gap that exists in terms of available information, right? So the gap between the edge of the inner circle and the edge of the outer circle, that represents um, our the impact of inside information. So the role of financial reporting can be argued to narrow down, to reduce the negative impact of inside information as much as possible. Fundamental value might never be achieved regardless, but you want to try to enhance the valuation of the company as much as. This activity we've already completed in the earlier question. Okay, moving on to the discussion of social significance of well-functioning securities markets. We saw that when information asymmetry exists, company stock prices will not reflect fundamental value. And that can sometimes cause investors to just not want to invest, not want to take the risk of investing. And that results in what's called thin markets. Do we have any evidence? Well, Wurgler 2000 shows us that countries that where the financial reporting mechanism has systems in place that provide more information that is specific to companies. Um, and so the stock prices reflect that firm specific information. They tend to enjoy better capital market allocation efficiency. And that's like a mouthful of saying that you have financial markets that work really well in those countries. So think about the US stock markets, or even Canada, UK, Germany, France, Australia, Singapore, Hong Kong. You see these as examples of countries where they have typically high quality um, reporting mechanisms, and they also tend to enjoy better allocations, better capital efficiency. Um, the higher the quality of financial reporting, the easier a company will find to raise money. That was a conclusion of Francis Juan Coran and Pereira in 2009. And these are not some people that just are writing, they've actually gone and proven these results. Okay, so these are research papers backed by evidence. These are not just conjectures. Biddle, Hillary, and Verdi in 2009 talk about how the negative impact of information asymmetry is reduced and investment efficiency is increased by higher reporting quality. Okay, so big takeaway is that we started uh, with the statement that if markets are efficient, well, Eugene Fama believes that markets are efficient. And in an efficient market, we expect to see all information that has been released to the public to be reflected in the stock price. But then we said that there was a logical inconsistency that arises you know when you consider that happening. What's the incentive for investors to keep track of any new information if everybody believes that stock market prices tell us everything that is publicly known about a company, why would anybody pay attention to information? We introduce the notion of noise traders. We say oftentimes people will make buy sell decisions that are not based on actual information. And so it creates a temporary opportunity for arbitrage. It creates a temporary opportunity for knowledgeable investors to make money. And that's why you never have a situation where new information becomes available and nobody actually acts on it, right? So we always have, well, um, people paying attention to new information as it becomes available. We did acknowledge that even in high functioning markets, we do have information asymmetry. We looked at numerical calculations involving coming up with an expectation about how a company's stock price will respond, taking into account the movements in the broader market prices, right? So, and we did that by using the capital asset pricing model, CAPM, where we said the expected return on a company's stock can be expressed in terms of the risk-free rate, the company's stock beta, and the market rate of return. And once we have determined what the expected return on the company's stock might be for a given period of time, we are then able to isolate the impact of the actual information released, and that is in the form of the abnormal return. So we looked at the example of Google making an earnings announcement last week, and we saw that there was a negative 1% return for that day. That we can argue is the result of the information specific to Google that became known. Not just the historic numbers, but also the fact that Google is experiencing some pressures in the form of additional competition coming from ChatGPT, etc. So the market responds not only to historical information, not in historical information rather, because all that would be included in the estimations, the expectations of the market, but rather to earning surprises. If there's any kind of surprise in the information, the market responds to the surprise in the numbers or in the qualitative information. We as accountants can make things better by enhancing the disclosure quality. So that is more or less the gist of chapter 4. Now, there's a whole bunch of homework that you folks can work on and your free time. We're going to move on to the value relevance of accounting information. And in here, we're going to look at a few learning objectives. We will try to explain how or why, rather, a securities market will respond to information that investors will find useful rather than any information. We will look at a hallmark, a seminal study conducted by Ball and Brown, comes from 1968, still very relevant today. We will look at the concept of earnings response coefficient, ERC, and lastly, discuss why companies should not seek to pursue a policy, an accounting policy that tries to get the highest stock price reaction, because it could go contrary to the needs of society. So looking at the first learning objective here. So the value relevance approach to decision usefulness basically says the role of accounting is to provide information that is useful. We as accountants do not or should not seek to influence the decisions. We only should try, make an attempt to provide information that users can then put to use, depending on their expertise and their own prior assessments of taking place around them. The key takeaway there would be that the responsibility of how to use the information rests with the individual decision makers. Accountants are not supposed to make those decisions for them. And we do assume that securities markets are efficient, that markets will act on information that is made available from any source. So how is it that markets respond to financial information? The market doesn't exist in a vacuum. The market is a composite of individuals, right? The market is a composite of individuals. And these individuals have prior beliefs about a company's future performance. And that those prior beliefs are usually based on the information that the individuals have available at their disposal. Now, when any new piece of financial information is released, investors, assuming that they are rational investors, they will take the time to go through the new information. And they will compare this new information to their own prior beliefs. And if needed, they will update their beliefs accordingly. Now, when an investor's beliefs undergo an revision, so just like we saw with prior probabilities, posterior probabilities, there is a change in the expectation that the user has. Based on these revised beliefs, the revised posterior probabilities, the investors will act. They will either buy or sell the shares. Now, such buy and sell reactions will be widely dispersed across the market, right? There's probably hundreds of thousands of shareholders that a company has. Maybe out of 100,000 shareholders, 50,000 might not do anything, but or even 90,000 might not do it. But even when 10,000 investors may take actions, right? Some of them will say, oh yeah, the earnings numbers are really great, I'm going to buy some more. Others might say, these are not stellar earnings numbers, I'm going to sell. Or maybe the company's done really well. I don't really think there's more room for the company to grow, so I'm going to cash out. I'm going to sell and move. So when you have a large number of people making such decisions, taking such actions to buy and sell, it is likely going to result in a change in the stock price overall. And that market response can be seen either as an increase in trading volume or as a change in stock price. The stock price could go up or down. Now, I want us to just to pause on this and see if that is indeed borne out in what we were looking at for Google, right? So Google, we had seen so here historical data. So if you look at the days leading up to the earnings announcement, the earnings were announced on February 2nd. Yeah. Look at the trading volume leading up to the earnings numbers. Just look at this column here. So you have 40 million, 33 million, 42 million, 30 million, 33, 27, 29, 35. So relatively muted. And then the date the earnings were declared, there was a big jump, 69 million. And then the day after, 65 million. And today was the second day after the earnings numbers were announced. The trading volume is now down to just shy of 32 million. The average trading volume that Google has is about 32 million. So right about the time of the earnings numbers being announced, there was a big jump in the trading volume. So that is supportive of this first conclusion that there will be an increase in trading volume. Now, there can be a change in stock price, and we saw that happen for Google. The stock price went down, but that's not always necessarily the case. Okay. You would typically see a combination of these two, right? You will typically see a combination of an increase in trading volume and a change in stock price. Sometimes what will happen is that there is no increase in trading volume, but there's a big change in the stock price, and that'll happen for penny stocks, right? So stocks that have a that are very thinly traded, not a lot of people own them. In those cases, if there's an earning surprise, you'll find, the stock price goes up 20, 30%. Like really, because there the surprise um, is palpable. But for a large, widely held company like Google, the change in stock price itself might not be as much. So abnormal return that we saw was only 1% for Google. So that's not a huge change, but there was a doubling of the trading volume. So you will typically see a response, market response to finance. I'm trying to tie it to real world examples rather than examples coming from the textbook, right? This is happening. This is what happened in the last couple of days. Okay, so hopefully that'll be appreciated. So how do we test for the market response? How do we see whether the market has indeed responded or not? We have to acknowledge that markets will respond very quickly to new information. So we want to look for volume and price effects over a narrow window of time, preferably few days. In finance research, that window that they look for is just typically minutes, right? They look for maybe at most a couple of hours after the information became available. You will see typically huge spikes uh, shown up in activity right after the information becomes available. I wonder if I can show that to you for Google. Um, so over here, I'm just going to post the link to this because you might not be able to see very clearly on the screen. So if you click on this, the bars that you can see at the bottom, I don't know if it's that clearly visible, but if you at all are able to see the bars at the bottom, right? And if I was to zoom in, is it possible to zoom in? Not really. My apologies. Sometimes, on the screen, you can see exactly how much trading occurred at any point in time. And you would typically see the response is very quick. The moment the information becomes available within the next hour or so, the bulk of the trading will have taken place and the bulk of the stock price movement will have taken place. Just not able to show you that in action here, not on this screen. Maybe there's Google Finance. Alphabet. This is just showing the stock price. I can't see the trading volume. Sorry, I wish I could show you the trading volume as well. Over here, yeah, you can see the volume. All right. So over here, February 2nd, there's this drop in volume. And then so buy in the first 2 hours on Friday, right? Thursday, they reported the numbers. In the first 2 hours, you can see that the trading volume was like huge, starting from 839,000 going to 11 million, right? And then plateaus to 6 million, 5.2 million, 2.9 million. You probably had 20 million shares bought and sold in the first couple of hours. It's very, very, very rapid response when a new piece of information becomes available. Okay. Now, when we're trying to test for a market response, you want to see what happened in a short window of time, in a short period of time. But you also need something to compare, right? Like, when you say, yeah, there was a marked response, you need a baseline, right? You need something to compare. So you need to use a proxy for investors' expectations, and that investors' expectations can be proxied to be what the expected number is, right? So um, when we are comparing the actual numbers, we need some kind of basis for the expected earnings number. And that you will typically find with reference to analysts, right? So analysts are the usual go-to place for getting market expectations. And we've already used capital asset pricing model to how to separate market-wide um, the abnormal returns from the expected returns. When we are looking at the qualitative discussion, though, we should be able to separate market-wide factors from firm-specific factors. All right, so we have already picked up on that, the market model. We split it up between expected and abnormal returns. Now, something to keep in mind is that when you're looking for the market response, and we looked at Google. When looking at Google, it wasn't just the earnings numbers that the market was responding to. The market was also taking into account other information. And other information was, okay, Google is having certain challenges with controlling, its revenues are falling, declining. So maybe that is due to the upcoming recession. Companies are cutting back on their ad spends and so on. Or maybe there is this, the impact of our chat GPT, right? So how is Google, how is Alphabet going to respond to that? So it's very difficult when we calculated that abnormal return of -1%. We can't really claim that the -1% was actually in response just to the earnings numbers. Um, we can try to exclude companies for which other firm specific information was made available, but that's very difficult because in this day and age, when companies report earnings numbers, they also provide other qualitative information. The management discussion and analysis document contains other information. Very difficult for us to say, oh, we are going to ignore companies that provide information outside of just the earnings per share. And I've talked about the company's beta. The market model, capital asset pricing model, assumes that a company's beta doesn't change, that it stays stationary. That can change. A company's beta can change as the company's operations change, or if, let's say, its capital structure changes. Capital structure is the balance of debt and equity in the overall capital deployed by a company. So that means we have to estimate the company's beta at the point. If you go look up Yahoo Finance, it's giving you a beta calculation based over last 5 years. Maybe that is not a good proxy to you. Maybe we need a beta that's more short term, like maybe the last few months. That would require us to actually sit down and do the calculation. And sometimes we just don't have the resources or the time to be able to do that. All right. So in under such circumstances, laying clear claims about, oh yeah, the market responded to the earnings numbers may not be as straightforward a claim to make. I think we've already done this question number 21 from page 185. I believe we already did that, but let me check. Oh, no. This is IBM, an article in the Globe and Mail. This is really old, like we're talking about 20 years ago, right? An article in the Globe and Mail, February 16, 2002, reported that IBM used $300 million proceeds of a sale of one of its business units to reduce operating expenses in its fourth quarter 2001 income statement. This act added about 8 cents per share to its fourth quarter earnings. As a result, IBM beat analysts' forecasts by 1 cent per share. IBM defended its treatment by claiming that buying and selling businesses is a normal business practice and that most of the sale proceeds related to intellectual property that it had developed. The article quotes a Merrill Lynch analyst as saying, "Our only concern is that the company could have done more to call out the magnitude of the transaction." According to the article, IBM's share price fell by 4% as a result of this news. While not mentioned in this article, the Securities and Exchange Commission opened a preliminary inquiry into IBM's accounting practice, expressing concerns that IBM had let it be known that the reason for its higher operating earnings was tight cost controls rather than the sale proceeds. This inquiry was subsequently dropped, but the SEC issued a bulletin reminding firms to report gains or losses on asset sales separately from operating costs. Required is asking us, explain why IBM's share price dropped following the Merrill Lynch analyst comment and the news of the SEC's preliminary inquiry. Now, let's go back and reread what happened. You just focus on the first paragraph here. So we have this article that says, IBM was able to beat analysts' forecast by 1 cent per share because it used $300 million proceeds from the sale of a business unit to reduce operating expenses. And the result was an 8-cent per share increase to the fourth quarter earnings. If the 8-cent per share increase had not happened, IBM would not have beat analyst forecast, right? There was an 8-cent increase to the EPS, and IBM was only able to beat the analyst forecast by 1 cent per share. Had IBM not done what it did, it would have actually missed analyst forecast by 7 cents. Now you have to understand there's a lot to unpack here. Right? Analysts are seen as a proxy for market expectation, right? A company that misses analyst expectations is seen as having done poorly. You got to understand why. Why did IBM do what they did, right? So you know that from accounting, from an accounting point of view, if a company sells a business unit, that's typically right. The gain or loss on the sale of a business unit is typically shown as discontinued operations. And from intermediate accounting, you will recall that discontinued operations is shown, this item is shown separately from income from continuing operations. So I'm sure IBM had, it's a big company. I'm sure the accounting people at IBM knew this, right? They're not idiots. So why would they willingly include the gain on the sale of this business unit and try to and what did they do, right? They didn't show the gain. Instead, what they did is they reduced the operating expenses. So rather than reporting a gain on sale of such and such business, they use the amount of the gain to reduce the expense, an operating expense. So operating expense will be part of continuing operation. And they showed lower expense. They didn't report the gain. They instead offset the gain against the expense. So there's a couple of things happening. Number one, you're not showing the gain on the sale of your business unit separately, right? Instead of showing it separately, you included the amount of the gain in your income from continuing operation. To boot, you could still have reported the gain on sale there if it all related to sale of intellectual property. Okay, maybe it doesn't qualify as a discontinued operation. Maybe it's just a gain on the sale of assets itself. Fine, no problem. But then it should still be highlighted, flagged as a gain on sale of the assets. So they didn't do that. They instead minus the amount of the gain from operating expenses. Now, for a person that's looking at an income statement, if they see gain on sale of something, any person that has taken enough accounting classes will know that the gain is a one-time affair, right? It's a one-time issue. Like, okay, you sold some equipment for a gain, big deal. It's a one-time thing. But if you see the operating expenses going down and you compare it to the previous year, you go, oh, impressive. This company has been able to reduce its operating costs. Because that reduction is seen as something that will recur in the future. And so you will expect, oh, so this company has increased its earnings, and we expect this higher earnings to persist in the future. So all of a sudden, the outlook that the investor has, the takeaway that the person who's looking at the numbers will have, changes. Right? It's not a benign error here. It is, I would say, a very well thought out error. Right? They were trying to create an impression that the $300 million, $300 million is not chump change, right? It's not insignificant. That, you know, they wanted to create an impression that they were able to reduce operating costs by that amount, rather than acknowledge a fact that, yep, we sold a business for a profit, and this is the amount of the profit that caused our net income to be higher for the current period, but don't expect this bump to persist in the future. And especially analysts will pay attention to one-time numbers because they typically will back those out, right? So for an analyst, they will remove one-time such instances, and they would look at the number that is expected to persist. And that number that would be persistent would actually have been 7 cents lower than what the market analysts were expecting. So we would have expected IBM stock to fall when they reported their earnings numbers truly, but they didn't, right? They hid that fact. So there wasn't any immediate impact to the earnings announcement. But later on, when this article was published in the Globe and Mail, there was the market response. People said, hey, wait a minute, right? The analysts at Merrill Lynch, one of the analysts sort of firms, used to be a bank, investment bankers. So there was an analyst working at Merrill Lynch saying, you guys should have told us about this particular piece. So, by hiding the truth of the matter, IBM had done a disservice. And the response was, you know what, once the news became available, the market did respond, right? The market participants did respond by selling IBM shares, causing the price to fall by 4%. And then there's the impact. There's an investigation started by the securities regulator. The SEC is the securities regulator in the United States. So just based on what happened, I would not say that what IBM was trying to pull was such a well thought out strategy, right? Now, the question's asking us explain why IBM share price dropped following the Merrill Lynch analyst comment and the news of the SEC's preliminary inquiry. So the comment that the Merrill Lynch analyst made was, our only concern is that the company could have done more to call out the magnitude of the transaction. So for someone who's just reading this particular piece, it creates the impression that the Merrill Lynch analyst is kind of saying that IBM was less than truthful. When you have an impression about a company that they are less than truthful about reporting, that creates fears in the minds of individuals, right? People won't have time to sit down and wrap their heads around what really happened. They see this soundbite and go, oh my God, IBM is hiding stuff. And when somebody's trying to hide stuff, then that stuff is only got to be negative, right? People will only try to hide negative news. People typically don't hide good news about themselves. So people will, well, immediately market participants will assume the worst, sell, get out, right? And that caused the drop in the stock price. To boot, when you have a company being investigated, people think, oh, there's never a fire without, there's never smoke without fire, right? So if the Securities and Exchange Commission is conducting an inquiry, there must be something wrong going on at IBM. So in this case, you didn't really have to do a whole lot of accounting analysis. I showed you what the motivations that IBM had, right? I mean, why is it that IBM was trying to pull wool across people's eyes? Well, they were trying to make sure that they were not seen to be missing analyst expectations, but they did anyways, right? Once the news came out, they lost face, right? Their reputation must have taken a hit, and the stock price fell anyways. Any thoughts on this? Okay, not really. All right, guys. I'm just looking at the time. It's 7:52. I do need a response to this if there is anybody here. Do you want me to just carry on and finish, or do you want to take a breather at this point? If there's anybody attending, don't want them to feel overwhelmed. If you want to take a break, I can take a break. Okay, Kalita says we can keep going. All right, I will do just that. All right, then. Beaver, 1968. So Beaver's paper is one of the two seminal papers we've had in accounting. William Beaver published that paper in 1968 in the Journal of Accounting Research. It was one of the first papers of its kind at that time. Now you probably have thousands of such papers published every year. But at that point in time, Beaver's paper was one of the first empirical studies on capital markets. And what he did was he studied the trading volume of shares around the time earnings numbers were announced. So he looked at 506 annual earnings announcements from 143 firms listed on the New York Stock Exchange, having a year end other than December 31st, right? Most companies have December 31st year end. He, in order to make his sample more manageable, picked up companies that had a non-December 31st year end. And the time frame he studied was 1961 to 1965. And you don't need to memorize these details. I'm kind of giving you the context of what his study was about. And what he did is he calculated average daily trading volume for a 17-week period. So you had the week of earnings announcement, 8 weeks before and 8 weeks after. So 8 weeks before the earnings announcement, the week of earnings announcement, that's 1 week more, and then 8 weeks after. That gives you 17 in total. And in order to establish a baseline for normal trading volume, he used the average trading volume outside of the 17-week window. And then he plotted the results. So you see on this, in this chart here, what Beaver found. The dotted line that you can see is the average trading volume outside of that 17-week window. Week 0 is the week of the earnings announcement. And then you have 8 weeks before, 8 weeks after. So the period to the left is before the earnings announcement. The period to the right is after the earnings announcement. Now, if this is our baseline, the dotted line is the baseline, you can see that the trading volume in in the time period leading up to the earnings announcement was lower than average. Then, in the week of the earnings announcement, it shoots up. The trading volume shoots up. And then, just as quickly, the trading volume starts going back to normal levels and to the point that it goes below the average once you're hitting that 6 to 8 week after the earnings announcement mark. So, key takeaways, you have a marked increase in trading volume in week 0, the week of earnings announcement. And you have below normal volume in weeks leading up to the earnings announcement. And I showed that, so 1968, 2003, I showed you that with Google's numbers, right? So in the days leading up, so he was looking at weeks. Now that period of time has been reduced to a matter of days, but you still see that pattern, right? For Google, we saw the trading volume leading up to the date that the earnings numbers were released was considerably less than average. Shoots up, comes back down, and again drifts back to the average. So you have this spike at the time the earnings numbers are announced. So earnings are still relevant. Right? There's folks in finance that say accounting numbers are irrelevant because they only tell you the story about the past. And what we continue to see is that earnings announcements are still relevant because there is a spike in trading volume, right? So maybe earnings numbers don't tell us much about the future, but they still must have some validation value. They must have some feedback value that they give people the confidence that the predictions that they had made about the company, whether they were borne out or wrong or not, okay? And people do act on earnings announcements. And it's too much of a change to be solely ascribed to noise traders. There's got to be more happening. Okay, so it's 45 years ago that Beaver published his results. Those results are still applicable to us. The second paper that we have to be aware of is the Ball and Brown study, also published in the same 1968 year. Now, Ball and Brown, again, just like Beaver, was one of the very first empirical capital market studies. And in their case, it was what would be characterized as an event study, where uh, these were, I think, Ray Ball was 22, 23 years old, and Philip Brown was like, I think, 25 years old. They were both graduate students, um, really, no more than mid 20s. And on a lark, they decided, oh yeah, we are going to, we're going to look at numbers, whether we can tie numbers to account. So they wanted to study the market reaction to a company's net income release. They go on a lark and they pick up a sample of 261 companies, again listed on the New York Stock Exchange. Why New York Stock Exchange? Because market data was widely available for the New York Stock Exchange. They had all the data on magnetic tapes maintained, so they were able to pull up the data. They looked at a 9-year period, and for 261 companies over 9 years, 261 times 9, they had 2,349 observations. Again, you don't need to memorize any of this. This is just the context, right? In today's day and age, when if somebody wants to do such a study, they'll probably be using hundreds of thousands of observations. Did not have as much data, but they tried to do the best they could. So what was their methodology? What did they do? First, they determined if the earnings contained good news or bad news. Now, good news, bad news, how do we tell, right? How can we say whether the earnings numbers are good or bad? They said, let's compare to last year's numbers. If last year's numbers, so if we say if the company had an earnings per share of $1 last year, then we would expect that the company should earn at least $1 this year as well. Now, if the actual EPS for the company is more than $1, i.e., if the actual earnings in the current year is more than last year's net income, then that's good news. If, on the other hand, the current year's net income is less than last year's net income, then that is bad news. You will notice that they were more or less evenly split in their numbers, 1,231 observations of good news, 1,109 observations of bad news. Okay, reasonably balanced data. Second, they calculated abnormal returns. Now, abnormal returns, that the examples that I showed you, I calculated for a day. They, on the other hand, calculated abnormal returns on a monthly basis. They didn't have daily returns calculations. So they used the monthly returns for the month of earnings announcement. And then they also looked at 11 months before the month the earnings were announced and 6 months after the earnings were announced. So you have the month during which the earnings numbers were announced, 11 months earlier, and 6 months after. So 11 plus 1 plus 6 gives you 18 months in total. And then they plotted the cumulative abnormal returns, and they ended up with this chart. So over here, this blue line that you're seeing, this is sort of corresponding to the earnings. So zero would be when the earnings numbers were announced. So the blue line just shifted a little bit, should have been closer to here. After the earnings numbers were announced, so this one should be a little bit to the left, my bad. There was a response. Now, it might not be very discernible here, but there was about a 5% gain compared to about a 9% loss for the bad news firms. So compared to the total sample, the companies that had good news in their earnings, their total returns, cumulative returns, were more than the overall sample, the overall average. The bad news firms had an overall cumulative loss greater than the total sample. The good news firms did better, bad news firms did worse on average. But what is very important to see is starting from the same point, right? This is just a this is an index calculation. It's an abnormal performance index. It's almost as if the good news was anticipated by the market as well as the bad news. And so what is clearly seen is that the market didn't have to wait, right? We didn't have to wait until the earnings numbers were announced. It's almost as if the markets had begun to anticipate which companies will do well and which companies will do poorly, which provides support that markets will incorporate all information as soon as it becomes available. There is no lag. So far, this is perfect because it supports the viewpoint that markets are efficient. But then something else was noticed. And that part was that even in the month of the earnings announcement, there was a noticeable response, right? So if markets already had incorporated the good news or the bad news, why was there an abnormal return seen when the earnings numbers were actually announced? It makes sense, right? So that kind of provides support that there is some feedback value to earnings numbers. But then what they found was that there was a little bit of momentum. For the good news firms, the stock price continued to go up. For the bad news firms, the stock price continued to go down for as much as 2 months after the earnings were announced. That has been termed the post announcement drift. So, after the earnings numbers are announced, for companies that report good news, their stock price continues to go up for a while before it settles down. For companies that report bad news, their stock price actually continues to go down further until it sort of does a reversal. That shouldn't happen. Is that an anomaly? Because if you think about it, if markets are efficient, efficiency requires a speed of response. Like it should not take the securities market, stock markets 2 months to digest it. That's too long. So what's happening? We would have dismissed this as being, oh yeah, it's just something that these guys found 45 years ago. Well, even today, well, I'm saying 45, 55 years ago. My apologies, my math is bad. 55 years ago, these guys reported that there was a drift. That thing happens even today. Researchers are still carrying out studies and they're reporting, post-announcement drift. So that is crazy. And we will return to this part again when we discuss our securities markets really, truly efficient. In the meantime, let's talk a little bit about the concept of causation and association, causality versus association. So, one question to be asked based on Ball and Brown study is, was it the earnings announcement that causes the market response? It depends on whether we are strictly doing the calculation over a narrow window. So, in the calculation that we did, we calculated the abnormal return for Google for a day, right? So, earnings are announced, look at the numbers next day. If we are doing the calculation over a narrow window and there's no other complicating information, then we can say yes. But usually that is impossible to do in these days because most companies, when they report earnings numbers, they will also provide some other information. And so it's difficult to say that the market response was really driven by the earnings numbers, or was it, the other information that the company returned. That's becoming hard. And then the second thing, do stock price changes, are they related? Are they associated with earnings numbers? And so we see with the Ball and Brown study over a long period of time, if we observe it over a long period of time, we see, yes, they do, because prices seem to lead earnings, right? In the Ball and Brown study, we saw that the companies that were reporting good news, they saw their stock prices go up and up and up. The companies that were want to report bad news, their stock prices had started falling way before they actually reported the earnings numbers. So these price changes happen months prior to the earnings numbers being announced. So that itself could be due to the fact that accounting information, is historical looking. It's calculated later, and there is something called recognition lag when we calculate net income based on historical. We will revisit this notion later on. So researchers have carried out research looking at long-term association between earnings and stock returns. Beaver, Clark, and Wright in 1979 say that the larger is the change in unexpected earnings. So If the markets were expecting a certain amount of earnings, and remember, markets are proxied by stock analysts. So for the IBM example we saw, if the stock analysts were expecting a certain amount of earnings per share, that was a baseline. If the company reports an earnings number that is different from what was expected, if the number is higher, then we say the company beat market expectations. If the number was lower than what was expected, then we say the company missed the market expectations. Beating market expectations would be seen as good news. Missing market expectations would be seen as bad news. So Beaver, Clark, and Wright said the larger is the unexpected portion of the earnings, the larger will be the abnormal return as well. Easton Harrison Olson in 1992 says, if you study the association between stock returns and net income over a long period of time, you'll find the two are more correlated. Over a short period of time, stock prices and net income likely will be less correlated. And that was validated by Warfield and Wild, that the strength of the association between the stock returns and earnings is about 10 times stronger when you look at annual 12-month periods than if you try to calculate that correlation for quarters. Quarters are 3 months, right? So if you calculate on 3-month periods and compare that to the correlation for an annual period, the correlation strength is 10 times stronger for the annual numbers than the quarterly. Right? So in the longer run, stock returns and earnings are correlated. And the rationale for that is that if we did operate under ideal conditions or try to reach ideal conditions as much as possible, in the long run, our total reported income will be equal to what it would be under ideal conditions, right? So we are no longer kind of applying the arbitrariness of accrual accounting. Well, in the longer run, true economic income is reflected. Next up, we will look at the concept of an earnings response coefficient, ERC. So ERC is calculated by dividing the abnormal return by unexpected earnings. So it's a measure of a company's abnormal stock return in response to the unexpected component of the reporting earnings. So if you see an ERC of say 0.45, then what we're saying is that for every $1 of unexpected earnings per share, the company's stock will have an abnormal return of 45%, 0.45. So ERC has been a very useful construct in accounting theory, and it's been related to risk. You'll find the riskier a company stock is, the lower will be the earnings response coefficient. The reason being that the higher the risk of the stock, the higher will be the required rate of return, right? And so companies, investors will typically be unwilling to respond favorably to good news. And that's going to result in lower earnings response coefficient. Commonly used measures of risk include beta and capital structure or leverage. The leverage is indicated as the amount of debt a company has relative to its equity. So high debt to equity ratio will indicate higher leverage. So in both cases, higher the beta or higher the leverage, we expect the earnings response coefficient of the company to be lower, all things being equal. Another construct that ERC can be related to is earnings quality. Okay, so earnings quality can be conceived of as higher main diagonal probabilities in the information system. And we can use certain proxies such as the persistence of earnings and the quality of accruals. Persistence of earnings is the tendency of the good news or bad news in earnings to carry on in the future. So if you think about IBM, in the example on IBM was suggesting that they had managed to reduce their operating costs. So a reduction in an operating cost implies good news, which so if we're talking about operating costs, we expect such reduction to persist in the future, right? Whereas had it really been the gain on sale, it would just have a persistence of 1. So Ramakrishnan and Thomas identified earnings as having different degrees of persistence. We have permanent persistence, transitory earnings, and then there are certain items that are zero persistence items. Example of transitory items we just saw, gain or loss on the sale of equipment. It's a one-time thing. Something that is price irrelevant would be the result of, say, a switch from straight line depreciation to double declining. Yes, there is an impact on your earnings number, but the cash flow impact is zero. Over the useful life of the asset, the depreciation has to be the same. It doesn't really result in any kind of persistence. Permanent earnings, though, permanent change would be where a company has either permanently increased or decreased its revenues or expenses. IBM, that example, was relevant because IBM was trying to project that it had achieved a permanent reduction in its operating costs. And that would have a much larger impact on stock price. Okay, the persistence will result in an impact on the stock price to the tune of 1 plus risk-free rate divided by the risk-free rate. So if the risk-free rate, for example, was 5%, you're talking about 1 plus 5%, whole thing divided by 5%. Stock price should go up 21 times the change in the earnings due to that particular item. So that 8 cents, if let's say risk-free rate was 5% at that time, that should have had an impact of increasing IBM stock price by 21 times 8, $1.68. So that would have been a big, massive increase. Accruals quality has been studied by a researcher called Patricia DeChow. And, they looked at net income and they said, okay, net income we can split into operating cash flows and net accruals. And if you recall your cash flow statement, we start with net income and then we make adjustments to net income to get cash flow from operations. So if you compare the net income number to the cash flow from operations, the closer the two numbers are to each other, the higher we say is the earnings quality. Because you can have net accruals that are either positive, which is income increasing, or negative, which is income decreasing. For example, changes in accounts receivable. So if accounts receivable goes up, right, debit accounts receivable, you typically credit sales revenue. And so the result will be net income is higher as a result, right? So an increase in accounts receivable is income increasing, so it's positive. An increase in accounts payable, on the other hand, might be seen as income decreasing, so on and so forth. When we talk about accruals quality, we're looking at the extent to which the accruals that we made in the current period will show up in the next period's cash flows. And this can be done by doing a certain regression, changes in the working capital for time t can be looked at as the cash flow from operations from the previous period, cash flow from operations for the current period, and the cash flow from operations from the following period. And then you have this error term epsilon. The higher this error term that you get, the lower is the accruals quality. Don't worry, you don't have to do the regression. I'm just showing you how accruals quality can be calculated. And the logic is here that if a company has higher accruals quality, we should see a higher earnings response coefficient. Now, how is this whole thing related to market expectations? If a company is expected to have more growth in the future, we expect the earnings response coefficient for that company to be higher. Similarly, the more similar the expectations are about investors about future earnings, the higher will be the earnings response coefficient. So that can be shown if analysts' earnings forecasts are quite similar across the board, then we would expect to see a higher ERC for the company. There's research that supports this view. Brown et al., for example, said that analysts do a better job in terms of accuracy of forecasting earnings as compared to models derived from looking at data over time series. Analysts, their forecasts become more accurate as they carry out revisions, but they also tend to be a little more optimistic, especially for smaller firms. So when you're looking at analyst forecasts for smaller firms, you got to be a little careful. Now, all of this is summarized in this slide. The factors that are related to earnings response coefficient and what their impact is on the ERC. So just to sum it up, beta is an indicator of risk. Higher the beta, lower is the earnings response coefficient. Leverage is another risk factor. Higher the leverage, lower is the ERC. And when I talk about leverage, I'm talking about debt to equity. So the higher debt that a company carries, the lower its earnings response coefficient. Looking at earnings persistence, the higher earnings persistence, the higher would be the ERC. The higher quality accruals a company has, the higher will its ERC be. If you look at growth opportunities, a company that has more growth opportunities will have a higher earnings response coefficient. And a company for whom investors have similar expectations, that company will have a higher earnings response coefficient. Okay. Finally, we turn our attention to price informativeness. If we assume that markets are reasonably efficient, then we should get some information about the future value by looking at the current market price. Right? So if a company's stock price is more informative, the earnings response coefficient should be lower. Size can be seen as a proxy for price informative because companies that are large, they tend to be more in the news. But size can also, unfortunately, act as a proxy for other things like risk or growth opportunity. This particular evidence has been missing. So research has not been able to give us any conclusive evidence on whether size and ERC are related. So I have an activity based on earnings response coefficient. We got X Limited is a growth company that uses conservative accounting policies. Y Limited is growing more slowly. but uses current value accounting for its capital assets and related amortization. Otherwise, the two companies are quite similar. They have the same size and they have similar capital structures and similar betas. If both the companies report the same good news in earnings this year, which company would we expect to have the greater security market response, i.e., ERC, to this good earnings news? Now, if you compare, there's 6 factors that have an impact on earnings response coefficient. One being beta. Both companies have similar beta. The second one is leverage, capital structure. Both companies have similar capital structure. On those two counts, we can't really say anything. Then you look at the accruals quality. If you look at accruals quality, company X has conservative accounting policies, so its accruals quality should be high. Company Y is using current value accounting, so here the accruals quality may be a little bit low. So high accrual quality should be related to higher earnings response coefficient. So we see X should have a higher earnings response coefficient. Secondly, if you look at the expectations for growth, X is a growth company, Y is growing more slowly. On that count too, X is expected to have a higher earnings response coefficient. Okay. So we expect company X to have a higher earnings response coefficient. The reason is, in terms of growth, X is growing more rapidly than Y is. And in terms of accruals quality, company X is using more conservative accounting policies. On both counts, we expect that company X will have a higher ERC. If company X had a much higher debt to equity ratio and beta than Y, would our answer change? Well, now company Y, and if company X has a higher debt to equity ratio, company X will have greater leverage. Greater the leverage, lower is ERC. Also, if company A had a beta that's more than company Y, beta is an indicator of risk, and we would expect company X's ERC to be lower. In that case, we wouldn't really be able to conclude one way or the other, because for accruals quality and growth, X should have the higher earnings response coefficient. But if X also has higher leverage and beta compared to Y, well, then its ERC should be lower. So all things put together, in the case of B, we won't really have a definitive answer. We couldn't really say which company would have the higher earnings response. Finally, the last learning outcome is a discussion of whether companies should pursue accounting policies that will generate the highest stock price reaction. We have to keep in mind that accounting is a public good, one that's, if the information is available to one person, it doesn't mean that information cannot be used by someone else. So in that case, it's difficult for a company to charge for accounting information. Investors see the accounting information to be free. But at the same point in time, it's the company that has to produce the accounting information, release it, and there are costs involved. Actual cash costs of producing the annual reports, as well as the costs that arise from disclosing competitive information about ourselves. Because if the competitors come to know what we are doing, then that can limit our abilities to launch competitive products in the future. And in both cases, either directly or indirectly, these costs are borne by shareholders of the company. Now, when a company decides, oh, we are going to try to go for accounting policies that will help us generate the maximum share price bonds, we are faced with the challenge that the value of information that is produced, the social value of such information, we have to take into consideration the benefits that particular information possesses for potential investors and other stakeholders, and to balance those benefits against the costs that management and shareholders have to suffer. Now, because accounting happens to be public information, a public good, we can't rely on competition to figure out how much information will be produced. So if companies seek to go with accounting policies that will only generate a higher response, market response, we will likely not, we will likely end up biasing the information to the favor of shareholders and management, and we will not be able to provide the information that is necessary and beneficial to potential investors and other stakeholders. We will not have, as a consequence, an optimal amount of information being produced and shared. So if companies decide we are only going to provide information that will help us improve our stock price, it is likely going to result in biased information. And that is why in our um, conceptual framework of financial accounting, it said that information has to be a faithful representation of economic reality. And one of the attributes of faithful representation is neutrality, that the information should not be biased for one party's interests over the other. So that, my friends, concludes our discussion on chapter 5. There's a bunch of questions you can try out from chapter 5. And in anticipation of next week, you can read up chapter 6.